Hey traders, thanks for tuning in today. For those of you guys who've been following us for a while, you guys know that we recently, about a month ago, had released a trading advisory, and we have given a free trial for the last month, and we will continue it for the rest of August. This is becoming such a popular product that we want to try and get more people into it. Now, unlike other trading advisories, we actually give you the whole product in our free trial. We do not hide anything. We do not give you bits and pieces. Link in the description below, pinned in the comment section. You will get access for the rest of August to the whole thing. And you don't have to sign any contracts or anything like that. You just put your email in, just subscribe to it, put your email in. You get an email notification of everything that goes through. And that's the great part about it, is that we don't try to hide anything. And so we try to be pretty transparent with what we do. And today I wanted to share with you guys a sample of something we released in our pre-market wrap. Now, our pre-market wrap is a daily newsletter released pre-market every single day the markets are open that tells you guys what you guys really need to know, talks about trades that we're currently in, so much more, and that's just one of the many things we do. So this is just one of the pieces of our pre-market wrap, and this is just one of the many things we like to do, along with things like trade alerts, question and answer threads, ticker request threads where you guys can actually send us tickers to review. So how about you guys have a look? This is a really comprehensive review of what's going on in the markets, and we release this daily, every single day, pre-market. Take a look, everybody. Okay, we got a lot to talk about today in our pre-market wrap. I've decided to do this as a video. I am starting to like this format a bit better than doing it as a newsletter, just because I'm able to talk to all of you, talk about the charts, visualize it a lot better, give some commentary on it, and it makes it easier on me because I don't have to write out a whole newsletter, especially when I have something long to go over. So we've got quite a bit to go over today. First off, just taking a look at the S&Ps pre-market, seeing if we get any sort of pullback after basically 8 days of going up. Gold versus gold miners. Apple, we put on a trade over there. We had to roll that twice. I think we're going to get out of that trade at a profit. And I'm going to tell you guys how we're actually going to do that with the purchase of a call spread against a call spread that we shorted, and using the put spread that we financed to go and buy that call spread. I'm going to go over that whole trade right there, and we're going to get out of that trade probably by the end of the week, this week or next week, for a 20% profit, which would be an overall 2% portfolio gain based off the 5% that we put in on that trade. IWM, relative strength change, also an unbalanced butterfly trade on there, shorter term. QQQ, an income trade, so it's not really a directional trade. This is going to be a trade that we put on to make income. Facebook, old trade follow-up. We are up on that trade. I'm going to follow up on that. And then the dollar. The dollar's had a bit of a bounce, and I want to talk about that. And I want to talk about the euro dollar also, and the correlations between the two that we might see. So let's start off with what's going on in the S&Ps pre-market. So taking a look on a trading view, it's going to be SPX 500 USD. Taking a look right here, we have gone up now for 1, 2, 3, 4, 5, 6, 7, 8, 9 days. And so I think, or this is the 9th day, and at this point I do think we need a pullback. RSI is starting to get overbought. I do think we get a higher low from here on out. We've gone through extreme prices on support and resistance levels, and so what I mean by that is that generally, what I do is that I come up with a list of support and resistance levels. Some people call them market grid, whatever you want to call it. And I'll come up with support 1, support 2, support 3. On the other hand, on the resistance side, I'm going to come up with resistance number 1, resistance number 2, resistance number 3, resistance number 4. We have basically gone through the extreme resistance. And that's usually a sign that you're overbought. You might get a bit of a pullback. It's not going to be anything major. Like a day or two of consolidation and then continuation higher, or a day or two of a pullback and then continuation higher. Really not anything big, but you got to watch out for it on your shorter term weekly trades that you're going to be doing. Okay, gold versus gold miners. So seen an interesting thing right here, where if we go on to XAU USD, it's going to be spot gold right there. We've seen basically a large push up. We are at over $100 above the all-time high. But if we go on to something like the GDXJ and then take a look at that, that's had a lot of weakness. You can actually zoom out on that all the way. And what we see is that it is far from its high. Its high was at 170. Right now, it's all the way down at 40. So is there a trade to be had? And I think there is. Long GDXJ, short gold, is a trade to be had. I'm not going to be putting this out as a trade alert just because this trade is a very active trade. It requires you to manage it a lot, and here's the reason why. First off, you can't just put half in short gold and half in long gold miners. It's not as simple as that. Gold miners have a lot more volatility than gold, so you're actually going to have to go on and take a piece of paper and start sketching out the cash flows for the average gold miner in the GDXJ and actually determine how much leverage they have over the price of gold. Because if gold goes up 1%, the GDXJ can go up 3%. So it can have 3x leverage over the price of gold. And so now what it does is that creates a situation where if you're going to do a pairs trade, you have to short 3 times as much gold and go long 1/3 as less GDXJ inside a pairs trade. And so you're going to go short 3 times as much gold as you went long GDXJ. And so you got to weigh your betas right there too, because your beta, it's just a measure of volatility against the S&P 500 and measure of correlation, but beta is very low on gold. Gold is not that volatile usually. GDXJ, on the other hand, this is an extremely volatile product. So it's really hard to pairs trade because you can't just do notional 50-50. Like usually when we do pairs trades, we'll put 50% long, 50% short, right? You can't do that over here though. Because GDXJ has so much volatility, has such a high beta, gold has such a low beta. So if you do go short gold, long gold miners in a pairs trade, you're going to have to short a lot of gold, and you're going to have to go long very little gold miners. And you're going to consistently have to re-hedge it. So it's a very active trade. It's a trade where you have to be nimble with your beta weighting too. And that's why I'm not going to put it out, and I think most people are going to have a hard time doing the trade. I just want to let everybody know there is a trade idea right there. And longer term, there is probably something, we've been bullish on gold for a long time as long-term investments in gold and silver miners, but there is probably a valuation question of whether these gold miners and silver miners are massively undervalued. And so that's a longer-term investment right there to think about, but I just want to let everybody know that there is possibly a trade to be had right there, and that valuations are extremely low in these gold miners compared to the price appreciation possibility and the price appreciation that has already happened in gold. So we went through right there gold versus gold miners. Again, not a trade I'm going to put out. It's a very active trade. You got to know what you're doing with the beta weighting. I don't think most people are going to be comfortable in that trade. But if you are, I just want to let you know about that. And I do also want to let everybody know on a long-term investment perspective side that gold miners are extremely cheap relative to the appreciation in gold and the leverage that they have over it. Okay, Apple, trade that we put on 2 weeks ago. So let's take a look at Apple. Okay, so we had this large gap right here. And I put on the trade. Again, it was very overbought on a longer term time frame. Very overbought on a longer term time frame, and it has gotten even more overbought. The most overbought it's really been since 2012 at this point. And so I put this trade on the upside, and I had essentially thought, okay, it's overbought. We're going to have earnings, a little bit of volatility contraction maybe after earnings, take advantage of that, and we really don't need to go lower. It just needs to stay the same. Maybe it can even go up a little for that matter, right? And so I put on this trade, and of course, it did go against us. And so I rolled it up, and I thought that we would actually get a gap fill. Right here, I circled that right there. There's poor structure on this chart. And what I mean by poor structure is that you have what we call a VPOC. Some people like to just refer to it as a gap. But basically right here, there's a big gap. You see this a lot on Apple and NASDAQ charts. And it means that the market has gone up so quickly that it's not even creating good structure on the way up. That's left a lot of gaps that the price will eventually come back and fill. 90 to 95% of gaps get filled. And so at some point it's going to get filled. The thing is, it's a shorter term trade, and you can have situations where gaps don't get filled for a year, for 2 years, for 3 years, right? The S&P 500 has very poor structure. but those gaps probably won't even be filled for another year. And so that's something you have to keep in mind, is that a lot of them have this sort of poor structure where the gaps never actually get filled. So I thought there was poor structure, but I wanted to wait. And so I rolled the trade and I said, okay, we're going to wait to see where that poor structure gets filled. It never got filled. And so that means that the momentum is not there to fill the poor structure, to actually go down and fix the structure. And so we still have that poor structure on the downside, regardless of the momentum is not there to push it down. And that's why we did a second adjustment, and with that second adjustment, I later came out and then I said we're going to short a put spread. So we shorted the put spread and we rolled it up later on. And so the reason I did that is because now I plan on using the money that we got for selling that put spread to go and buy a call spread to go and hedge our other call spread. It is a big complex of a trade, but basically we sold a call spread up here now, and then we sold it further on expiration. Probably like I think 8 weeks out or so, and we sold a put spread down here, but that was really close, 2 weeks expiration. We're going to use some of the premium we collected from selling that put spread to go ahead and buy a call spread up here to hedge that upside. So even though there's poor structure, this thing, from the way that it's looking, the momentum that we're seeing is going to continue to the upside after this small pullback, and I want to be there to hedge our short positions or short deltas that we had right there. And so we're just going to go long a call spread, and that's not really going to cost us anything because we sold a put spread. We sold a put spread for no extra risk. If you have a call spread that you already sold and you sell a put spread against it, you're doing it for no extra risk. Because the stock can go up and down at the same time, right? It either has to go up and it has to hurt your call spread, or it has to go down and hurt your put spread. It can't do both. And so it has no extra risk. But we're going to do that right there, add a call spread after a small pullback, and hedge our call spread that we sold. And we're going to do it for basically nothing because we sold a put spread for no extra risk, and we're going to use the premium collected from that to go and finance a call spread. Okay, IWM. This is one that I've been waiting on for probably 2 to 3 weeks now. And that's because I think we were in need of a sector rotation. So I came out, I said we're probably going to need a sector rotation, and then we got this tightening range. This wedge tightening range broke bullish, no follow through, consolidated, but now it's finally broken bullish, has gotten above this area of former resistance, now acting as support. And so this area right here, right there. And so what I'm going to be looking for is that we came up, we bounced off of it, and then we continued higher. And so I think this is finally the time that the Russell starts outperforming names like the NASDAQ. And so I want to put on a bullish trade. I do want to let everybody know, though, beforehand, this bullish trade that we're putting on is a very quick trade. We're going to put it on, and we're going to take it off in 4 days. But the reason I'm saying that is because you get the email notification, and you basically got to put on the trade right as soon as you get the email notification, because unbalanced butterflies, they decay really quickly. This is going to be a weekly option. It's going to expire this Friday. So they decay really quickly, and we're going to be selling more options than we're buying, of course, to take advantage of that time decay. But because we're doing that, you have to put on the trade pretty quickly, like within an hour or within 2 hours of getting the trade alert. So you can put it on for a large credit, and then the calls that we sell are going to start decaying. Calls that we buy are going to start holding their value a lot better in an unbalanced butterfly on the upside, which is what I'm looking to do on the Russell. I do eventually think this thing leads to all-time highs. And so I just want to do that, but I want to let everybody know that trade is a shorter term trade, so you get the trade notification in your email, and you just put on the trade, quick as possible, within 2 hours, I'd say, because that trade is going to start decaying really quickly. You want to take advantage of that time decay. So only put on the Russell trade if you get it, and you're able to get it on within, say, 2 hours. Okay. We just talked about that upside unbalanced butterfly trade that I want to do. QQQ income trade. So as I said, the NASDAQ's going to start slowing down. We had a large run up in the NASDAQ, and these things tend to go back and forth. So think about it like a track race and the baton that's being thrown, or the baton that's being handed over in a track race. Somebody runs, and then they hand the baton over to someone else, and then they start running, and they hand it over to someone else, and then someone else starts running, and you do that again and again and again. And That's what happens with these sectors. Is that in an uptrend, tech was the one that was running. Now tech started to get tired, it's going to start to hand it over to the Russell's going to start running up. And basically the bulls keep their momentum as long as these sectors are able to keep on handing it over to each other, and one of them is always running. As long as that's happening, you're in a good position. And so QQQ, I want to put on an income trade. It's going to be largely non-directional. It's going to be a little bit to the upside, skewed a little bit to the upside, but it's going to be a trade that we're putting on purely for income. It is slightly directional, but your delta is going to be really small. It's going to be like delta 5, delta 6, delta 7, very small single-digit deltas. And of course, when you buy 100 shares of stock, it's a delta 100, and every option covers 100 shares of stock. So it's very non-directional for the most part. And I just want to put on a quick calendar spread. I think there's a good opportunity right here. The Nasdaq probably goes slightly bullish, grind up, slightly bullish, but really just sideways trading. Whereas we're going to see the Russell really going bullish right here over the next, probably over the next 2 weeks. So I want to put on a bit of a calendar spread, just a nice income trade right there. Not too speculative. It's not going to be a speculative trade. We're going to speculate up or down. Just a nice, fairly non-directional income trade. Okay, Facebook, old trade follow-up. We're up on this trade right now, and I'm going to wait it out to see whether we fill this gap. So originally put on the trade right here, and I said Facebook's going to start going down. Put it on the morning of, and of course, it had gone down, but then they came out with the news that they're going to come out with a TikTok competitive product, and of course it shot up. But originally that was my thesis, that we get down to this 234 level, and I just keep on doing this downside broken wing butterfly till we get to that level. The nice thing about this broken wing butterfly is that even though you make money on the downside, there is no upside risk to it. So even though we saw this big pop up, there's no upside risk. The question becomes now, are we going to stay up? We did see this big pullback intraday. I want to see how Facebook trades today and the day after that, and depending on that, we'll see whether we want to take the trade off or not. Again, it's a positive trade, and it's also positive theta, and we can wait it out. We put it on for a slight credit. If you had put it on later in the day, I'm not sure whether it would be for a slight credit or not. After I'd sent the trade alert out, that's why it's pretty important as soon as you get the trade alert to try and go and put on the trade as soon as possible, because these trades can go quickly from a net credit to a net debit. Okay, dollar and euro dollar. Last thing we're going to look at today before I sign off, and I'm going to send the trade alerts for whatever trades we're going into later on today. So on the dollar, I want to take a look at the 4-hour time frame, where we're starting to see, and I want to see if this is going to get any follow-through. I think it might get some follow-through all the way to this resistance level. Basically, we came down, former support did not act as support, we bounced, but then we failed to go higher, and then we came back to that support. And then we've gone lower, 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 and lower. We had a low, high, lower high, or higher low, higher high. And that's how an uptrend starts, right? If you think about an uptrend, you're in a downtrend, and then you have a low, which is your downside capitulation, high, higher low, or an equal low also, and then a breakout to higher highs. I do think we see a breakout that leads to about 95.65 on the dollar index, and we're probably seeing a bit of a cup and handle right now starting to form. And of course, see this in euro dollar too. These things have, euro dollar has a inverse correlation of a little over 70% to the dollar index. And so we have seen the euro dollar come down year after year after year. Seen a bottoming formation after the United States started to get very dovish in their monetary policy. In long term, I am bullish on the euro against the dollar. I am bearish all fiat currencies because all fiat currencies lose value over time, and that's just true, right? I mean, the dollar has lost, since it existed, the dollar has lost 98% of its value, and so all fiat currencies will lose value over time, but over the next decade, I am bullish euro, bearish dollar. With that said, is this the right time to get in? I do think that we're going to have to wait another few months, but the interesting thing that we saw right here is that it got above this resistance level, which was former support and is now acting once again as support. Whenever you have a trend line, though, and this is what I want to talk about, whenever you have a trend line, let's say you got a trend line right there, you're usually touching that trend line and then you're rejecting from it. What the euro did, though, was that the euro came up, and then just acted really sloppy at that trend line. And so I do think we see a situation now where it does come lower, but it retests it after a couple of months and then breaks it and then moves to the upside. It's probably going to take in a couple of months because this is a long-term 1-month chart, and I do think we're a bit overextended, but I do think we come down somewhere around here and retest that. We probably break out after 6 to 8 months on the upside and actually break that long-term, decade-plus trend that we've had so far, downtrend on the euro, and we actually see the euro start to weaken. And that's because we haven't yet seen it, but or we haven't yet seen the dollar weakness completely play out to the downside all the way. Yes, we have seen the dollar weaken a lot, but it hasn't weakened. It's not that big weakening, that big crash that everybody thought was going to happen. I don't think it's going to happen yet. We're looking at the Fed's balance sheet right here, and the Fed's balance sheet is really just plateaued. I would need to see the Fed's balance sheet go and basically, in a way, the Fed's balance sheet, of course, isn't a price that can just break to higher highs. But, I need to see a new uptrend in the Fed's balance sheet to start saying that the U.S. dollar should start to come down. But the Fed's balance sheet has plateaued. That might be bearish for gold. But on the other hand, also the European Central Bank's balance sheet has also plateaued. So that's pretty, it doesn't mean much on euro dollar, but it does mean something for gold. And I almost always like to look at these balance sheets to start seeing what the Fed is doing. And it has a high correlation to the markets. Like on June 10th, we saw the S&P 500 top out, and it had a high correlation to what was going on. Right here, June 10th, we actually saw the S&Ps top out about June 8th. June 10th, balance sheet numbers came out, and we were topping out right here. And so it tends to have somewhat of a correlation. Right now, the market's still going up, and so it's actually diverging because it's starting to price in future expectations of the balance sheet going higher. But it tends to give you somewhat of a hint as to what's going to happen in the markets because the markets are so Fed-driven. But right there, keeping a look at the balance sheet in relation to gold and euro dollar. Other than that, I don't have anything else to talk about today. I will be sending out trade alerts. So later on today, again, remember though, for the IWM trade, that's a shorter term trade. You really got to put this sort of trade on within 2 hours of getting it. The QQQ income trade, probably got to put that on within the trading day, basically. And I'll try and send them out earlier inside the trading day. Other than that, Apple, got to make that trade adjustment right. That's going to be one last trade adjustment, and we're probably out of that trade within the next week to 2 weeks for a 20% profit. That's going to be 2% profit overall in our portfolios or so. And Facebook, old trade, we're going to look at that and see whether Facebook is going to come lower or not. Either way, we are up on that trade. And I'll see you tomorrow, everybody. Hey guys, thanks for sticking through the whole video. First off, very few people are able to do that. If you guys like the content that you guys saw, then please go ahead and, again, link in the description below, pinned in the comment section. It is free. I mean, I can't spell it out more than that. F-R-E-E, free. All you got to do is put in your email, and that's all, and then you just get an email notification of everything. And again, this is one of the many things we do. So what we showed you right here, if you thought that was good, if that was comprehensive, remember, we release this sort of stuff every single morning. And on top of that, today already, we've done 4 trades, right? So we release trade ideas on top of that and give you guys alerts for trades we're getting into and actually teach you why we're getting into those trades. So we don't just tell you what to do, we tell you why we're doing it too, and we answer all your questions, and we actually take ticker requests from you guys. Again, it's free, you can't spell it out more than that, right? Link in the description below, pinned in the comment section. I hope to see you guys there. Thanks for watching.